Hello, I'm Kyle Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're focusing on the 4 new labels for sustainable funds. Joining me to run through all the details and to chat through a couple of other trends in the sustainable fund world is Miranda Seath, who is Director of Market Insight and Fund Sectors at the Investment Association. So Miranda, to start off, could you briefly run through the 4 new labels for sustainable funds?
Sure. So we now have 4 sustainable labels, as you say. The first being suitability focus. And that's really intended for funds that invest in assets that are either environmentally or socially sustainable. And the key point there being that the FCA would now like to see that sustainability criteria determined by what they call a robust evidence-based standard of sustainability. So that's the first label, sustainability focus. Then we have what's called sustainability improvers. So this is really to recognise that companies are essentially on a journey towards becoming sustainable. So some companies are already there and to all intents and purposes acting sustainably, but some are in an improvement phase. So that might be around climate transition, for example, or some are kind of improving their social credentials. So it's really about becoming more sustainable over time. And again, firms will be required to demonstrate that the way that they assess those companies meets a robust evidence-based metric or standard. Then you have the third label, which is sustainability impact. So a little bit different here because what the contribution that is being made by the investment manager is a direct contribution really to the company or project that they're investing in order to drive sustainability. So really, this label is about the fund achieving a positive, measurable impact, whether that's environmental or social. And then the final label is sustainability mix goals. So that really recognises that there may be some funds that are doing a mixture of investing in sustainably focused assets or investing in assets that may be driving a sustainable impact. They may also be doing that across equities or bonds. And so really that label is to kind of bring together different strategies so that investors can see those funds as well within the mix.
And could you take a step back, Miranda, and tell our listeners why these 4 labels have been created?
So I think the really important point here is that we've seen over the past few years increasing investor interest in sustainable funds. But what it's been difficult for investors to do is to easily find those funds and have confidence in the characteristics that those funds possess. So what the FCA is trying to do here is to help make them more visible. So, for example, what we found when we did investor research in the past is that often people were Googling fund names to look for sustainable or responsible or ethical. And then they were looking more into those funds, but they might not have a sense of how those funds were achieving their sustainability goals or objectives. So the second strand of this, beyond visibility, is to say to investors, if you want to buy a fund that is within the sustainable focus category, for example, you can be confident that that fund has at the minimum, a sustainable investment objective, is using a robust evidence-based standard to assess companies, and then is reporting against that and telling you the key performance indicators that the fund manager is using to ensure that they are investing in sustainable companies. So that's a big development. And I think it's also coming off the back of regulation in Europe, where we've seen something which is called SFDR, which is helping, again, to group funds into different categories in order to make it clearer how those funds are investing and provide consistency of definition.
And of those 4 fund labels, have you estimated like a percentage number that will go into each of those 4 labels? Is there one in particular that you expect to be the most popular in terms of funds slotting into that label?
Yes, so we did some research with our members a couple of months back about where they intended to place their sustainable funds. And what we found is that sustainable focus is going to be the largest category. So we estimate about 30 billion in assets represented in that category, but that is definitely going to be the largest grouping, followed by sustainability mixed goals. The smallest category will be sustainability impacts, but that's not necessarily a huge surprise to us because of that requirement to demonstrate investor contribution. That's something where it's a strategy that is more specific than some of the broad-based multi-thematic funds that you might see in sustainable focus.
Now, some funds won't fit into any of those 4 labels. So what happens to these funds? Can they still market themselves as being sustainable?
So they can't still market themselves as being sustainable. Those funds are what we call funds with sustainability characteristics. But what they will have to do is they will have to provide a new document, which will come into force in 2nd of December, which is a consumer-facing disclosure document. So what they will have to talk about in that document is what their sustainable characteristics are, but why they specifically don't have a label.
And when will retail investors be able to see which label the sustainable fund is in? For instance, when will they be able to see it on a fund fact sheet?
So the first group of funds that have been through the FCA authorization process and have a label will be coming into force on the 1st of August. But we expect there to be a small number of funds at that stage. The more important date, arguably, is the 2nd of December date, where you will see a larger group start to talk about what sustainable label the fund has and also some of these key metrics that the FCA expects to see around their sustainability credentials. So investors should start looking out for that in December, and they will also be able to download the new consumer-facing disclosure documents, which provide another level of detail.
I read an interesting report from Citywire, the financial publisher, which found that in the run-up to these labels being created, there's been a small number of funds, and I should emphasise that it is a very small number, it was around 10, that have removed sustainable from their fund name, which to me is a potential red flag. Have you seen any other trends of funds making changes to either their name or their investment strategy ahead of these labels coming into force?
It's interesting that you say it's a red flag. I think we have to think about what the FCA is doing within these new rules, which is essentially it's setting criteria around what it is to be a sustainable fund, what sustainability means, and it's setting a high bar. So at the minimum, a fund will be required to have a sustainable investment objective and go into quite some detail about the key performance indicator that the funds use and that robust evidence-based standard that the fund is required to meet. So for some funds that have talked about their sustainable credentials, there will be a change because they may be doing something like operating exclusions. They may be operating a strategy like what we would call positive tilt. And essentially what that means is looking at companies and saying they're doing pretty well in sustainability terms. They're meeting a certain standard and we're going to select them, but it's not going quite far enough for that fund to be able to get a sustainable label. So those funds are probably going to start talking about what they do in terms of responsible investing, which is not a term that will be covered by the naming and marketing rules. So it's not necessarily that the funds are changing what they're doing, it's that the FCA has decided to set a baseline level above which you can call yourselves a sustainable fund, but you have to meet that specific level. And I think you will see more of that happening in December as funds fall on either side of that line.
And around the same time that these 4 labels have started to come into force, there's also been separate anti-greenwashing rules as well. And hopefully, both the labels and the anti-greenwashing rules will have the desired effect of reducing the risk of investors being swayed by claims that are vague or unsubstantiated. What would you say for a retail investor are the main steps that they can take to try and find a fund that meets or is very close to their own personal values?
Well, obviously, once a labelling regime comes in, that's a really good starting point. So you might want to go for those funds that are investing in companies that are really doing something very environmentally progressive or very socially advanced, and that speaks to your values. And you might be finding those in the sustainability focus label, or you might decide that you want to see a fund that is able to contribute to driving a change in a particular area, for example, like building a social housing project. You might want to then look at something like the sustainability impact label, or you might feel that the most important factor for you is about the climate transition, net zero targets, meeting those objectives that have been set out in treaties like the Paris Alignment Treaty. And so you might be looking for those types of funds within the sustainability improvers label. And if you want a bit more of a mixture, sustainability mixed goals might be your starting point. So on an investment platform, you might be looking for those flags or characteristics on the fact sheets to start with. And I think you do have to really take a look at the investment objective of the fund and what that sustainable investment objective looks like. If you're looking for a sustainable fund in particular, is that aligned with what you would expect to see or what matters to you? You might be looking at the types of industry sector that fund is deliberately excluding. If it's very important for you that the fund is not investing in tobacco companies, for example, you need to have a look at the information provided by the fund to check that. But I think what we will see with this new regime is more detail exactly on how that fund is measuring the success of what it's doing and how they actually choose whether a company is sustainable or not. So, for example, they might provide details saying, we start from a basic premise that a company has to have, let's say, 50% of its revenues aligned with a particular UN Sustainable Development Goal or a particular type of activity. So you're going to be getting more detail on what the fund manager thinks is the baseline requirement and then how it selects those companies. I think you can also have a look at the top 10 holdings to see what the fund is holding. And again, there's a balance between the information that can be provided in literature like a fact sheet, which hopefully is kind of a short document where you get the main information that you need, and with more detailed documents, which might go into a lot more detail on, for example, the fund's stewardship or engagement activity, how they're engaging with companies to ensure that they are on the right trajectory for the fund's sustainable investment objective. So look out for some of that detail, which may be provided in links where you can go to documents which go into much greater depth if that's important to you. So, I
mean, personally, I'd like to see a lot more of that. Like, in the same vein that you see a fund manager say in a quarterly report over that 3-month period, we bought X, Y, and Z, we sold X, Y, and Z. I'd like to see more information in regards to, okay, over the 3-month period, we engaged with this company on this issue, and this is why we've engaged on this issue. And even if, there may not be a short-term outcome to begin with, but, I think they get across that, over the medium to long term, this is what matters to them, and this is what they would like to see the company change for good. Then I'd just like to see more of that, really. I mean, is that something that you're seeing fund firms do more often?
Yes, I think so. And, a lot of firms have what you're talking about there, which is an engagement report, talking about the activities or stewardship report, where they've gone into firms, what they've talked to them about, how they're measuring that, how many firms they've seen within the portfolio that they hold. You're also going to see more around reports that may talk about individual companies. They may have a spotlight on, let's say, 3 companies in that portfolio and why they've chosen them and if they've engaged with them, what they've done, or further details that are useful to the investor. So I think what firms are really conscious of is that balance between simple, clear statements so that an investor can at a glance see exactly what the fund is trying to do sustainably, and then giving the investor access to more detail where they want to see that, which really shows in depth how they've been engaging with companies and what their strategy is intended to do.
Because I can see the argument that, with certain things, it may be best to keep it behind closed doors. And then the other side of the coin, if a fund manager wants to see a company change in a certain way, they may take the more activist approach and shout about it a bit more. But as mentioned, I just think it'd be just great for retail investors to see the examples, to hear, what are the main sustainable items, if you will, that they would like the company to address over the medium to long term. I wanted to now move on and ask you about demand for sustainable funds. So I think it really did take off about 3 or 4 years ago. There's a lot more demand for sustainable funds relative to their history. It feels like that demand has cooled a little bit over the past year. Is that a fair assessment?
It is in our data. So we collect data on what UK investors are doing, where flows are going, and we do have a responsible investment category. So that is broader than the FCA's sustainability labels. That would include funds that are operating exclusions, for example. But what we've seen in that data is that we actually haven't seen an inflow to responsible investment funds for a year. So the last time we saw an inflow was in May 2023, and actually the latest data shows a 405 million outflow. Now, I think a lot of that is to do with the market cycle. So it's been a tougher environment for funds investing in equities, and the majority, I think it's 2/3 of our responsible investment funds are investing in equities. And particularly equity growth funds in our data have had a more challenging environment recently because we've had higher interest rates and because of rising inflation. So I think some of what we're seeing is cyclical. Because in the heady days of 2021, where we saw massive amounts of money flowing into responsible investment funds, you had a great environment where you could invest sustainably and see really good performance. Those funds were investing often in technology and healthcare, and those sectors were doing really well. Then you get to 2022 and you have Russia, Ukraine, that market shock happens, and suddenly the types of sectors that started to perform well in equity, like oil and gas, were the types of sectors that responsible investment funds typically exclude. So investors have seen a different performance environment. I don't think they're turning away from sustainable funds necessarily, but they may not be allocating more capital to them.
And from your own data, do you see that there's a split in terms of age? You see a lot of reports saying that, younger investors are more attracted to sustainable funds than, say, their parents. Is that true?
I think it's quite a nuanced area to talk about. So we don't know what the age of the investors are when we're looking at our monthly fund flow data. But what we did do in April this year was a survey of investors around ISA season. I think what we found in that data was younger investors had greater confidence that sustainable funds would actually meet their investing goals compared with the over 55s. So I think it was 7% of over 55s had that level of confidence. And I do think that there is something to be said about younger people having very strong views about sustainability and it being very important to them. But they are also possibly less experienced and may not have been through different market cycles as well. So for the older investors who may have seen different levels of performance, that's probably a factor too. And I would say that sustainable investing is not new. It's been called different things. You might, if you go back 20 years, see more ethical funds in the mix. But it is something that people have been able to invest in over a fairly long period of time. When we go and speak to investors directly and smaller groups of investors, what we found is that there are older people who find sustainable investing very important to them. It's one of the most important criteria they look at. And there are older people where it's simply not important, and that goes for younger investors too. So I think when you look under the surface, it's quite a personal thing, actually. So I wouldn't use blanket terms around older investors being less engaged necessarily. I think there is quite an individual element to this when people are looking at how they want to invest. The other thing that I would say is that almost all investors that we talk to, sustainability is important, but so is performance and financial return. So I think people are thinking about both together, which is why I said when you first asked this question that I think it is something to do with the return environment rather than investors not believing in sustainable funds or not being interested in sustainable funds that is driving weakening flows.
And I wanted to end by asking you about another piece of research that you carried out. So the research showed that younger investors are more confident that sustainable funds will help meet their investment goals. I think the survey showed that nearly a quarter of younger investors strongly agree that sustainable funds can meet their financial goals, compared to only 7% of over 55s. I thought that was really interesting. Why do you think that's shown up in the research?
Yeah, so I think as we talked about, it's partly to do with younger investors really believing in sustainable investment strategies and sustainability just becoming a part of exactly how they think about everyday life. So, for example, I think if you look at broader studies on the way that younger investors buy clothes, they may be less willing to buy new clothes, for example. They may want to look at that market for secondhand or indeed renting clothes. I think in every aspect of their lives, they are thinking about how they can make a difference, because obviously they are going to be living on this planet for a lot longer than I am. And I think they're very conscious of how they think about sustainability, how they can make a contribution. I think for older generations, there are certainly elements there where they care a lot about sustainability. If I think about my mother and her recycling habits, they are, she is thinking about making a contribution all the time. But it perhaps may not quite be in the same way or to the same degree that younger investors care about these things. But as I said, I think there's also a point here around older investors tend to be fairly experienced, and this view around different market cycles, some of the factors that are affecting the performance of equity funds, for example, like interest rates and a higher base rate, older investors probably thinking about those types of impacts in a way that maybe younger investors are going through at the moment, but haven't quite experienced what that might mean for their fund returns. So I think there's a balance of different factors affecting this, but it's certainly the evidence does suggest to us that for younger investors, sustainability is a really important element, but also it's interesting to see that confidence as well that they have that ultimately over the next 5 years or so, sustainable investing will meet their investment goals.
My thanks to Miranda, and thank you for listening to this episode of On the Money. Hope you've enjoyed it. You can follow the show in your podcast app, and do spread the word by telling a friend about it. If you get a chance, please do leave us a review or give us a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.